episode 11 of The Wealth Show with Equity Kings. Welcome to The Wealth Show with Equity Kings. My name is TUMISHO, and I'm with my co-host Siyabonga Chuma, and we're joined by a special guest today, Ryan Miller from Ryan Miller Trading Economics. Welcome to the show, Ryan. It's good to have you on the show. This is your first time on our show. This is our first interview, so it's very good to have you on the show. Could you just address yourself to the listeners and just tell the listeners who you are, what do you do, and what are your expertise?
Thank you. It's a pleasure to be here. So as you said, Ryan Miller. I consider myself a trader. I day trade the FX market, foreign exchange. Although I don't, none of my work that kind of gets published is ever about that. I don't talk about that too often. So I day trade FX, and then I kind of focus. I'm passionate about kind of macroeconomics and learning about the economy and money and how those things kind of influence the global system. Mm-hmm. I don't consider myself an expert in anything. I'm just learning just like you guys. But I do focus, I would say, a little bit more on the monetary side as opposed to the economic side, although I do both. Most people, I think, have a focus. They're either focused on the monetary side, they take that perspective, or they take an economic perspective. I try to combine the two. So I write about both on my website. And yeah, I just try to break some, I guess, more complex things in the markets down and make them a lot simpler for people. That's my main objective, just to make things a lot easier to understand and try to help people understand the global system, because it wasn't that long ago where I didn't understand the global system. I didn't have an education in economics. I kind of was self-taught through websites and mainstream articles, things like that. So I kind of learned a mainstream approach to economics. And then kind of March 2020 happened, and it kind of didn't make sense to me. A lot of things didn't make sense, and it caused me to take a deeper dive. And since then, I've been learning how the global system actually works, and it's mostly the opposite of how everybody thinks it works. And yeah, I think that's where I'm at today.
Yeah, and it's interesting you say monetary. You're focused on monetary stuff. So with regards to the monetary stuff, and I think that's why I wanted to interview you in the first place, is I wanted to talk about banks' balance sheets, because this has something to do with quantitative easing. But before I get to quantitative easing, I just want to go through how a bank's balance sheet is actually constructed, because I think people, in order to understand quantitative easing, you have to understand how banks' balance sheets are constructed and what is on their assets, what is on their liabilities, because a bank's balance sheet is different from a non-bank's. I mean, there's a big difference between the two. So, Ryan.
So, my middle name is Richard, so it's all good.
Oh, okay. That was a blessing, a mistake there. But yeah. I think it was a clever mistake, though. But okay, so how would it work? Let's say before quantitative easing, right? And my listeners know what quantitative easing is. In season 1, I was explaining what quantitative easing is. It's the buying of treasuries with bank reserves. Basically, the Fed creates bank reserves out of thin air, and then it's basically an asset swap with the banks or the primary dealers, for lack of a word. So how would the banking system settle transactions? Let's just say I have an account with JP Morgan Chase, right? I have a checking account with JP Morgan Chase, and I want to send $1,000, for example. I want to send $1,000 to Sia in his account with Wells Fargo. So you see, there's two different banks there. So Wells Fargo would send a liability, a deposit, or JP Morgan Chase would send a liability, a deposit, a $1,000 deposit, which is a liability of JP Morgan, and sends it to Wells Fargo. But what would be the asset to basically settle that transaction? Because if JP Morgan just sends a $1,000 liability to Wells Fargo, then Wells Fargo is basically bankrupt. It's basically on the hook because there's more liabilities than assets. So what is the asset that JP Morgan has to send to Wells Fargo to balance the balance sheet? Do you have any idea what that may be, Ryan?
Yeah, I mean this this stuff gets pretty nuanced and complex at times. And this is like Jeff Schneider's expertise that we're always talking about. But it kind of I guess it would depend on what the liability is, if it's debt or whatever it is. But if it's just one bank owes the other bank $1,000 prior to QE and all these reserves entering the system. Now there were still reserves prior to QE. They were just at a very minimal level, just enough to satisfy regulatory requirements. So it often these transactions would go through like a third-party clearing system, and that third-party clearing system was often like JP Morgan, and they had their own kind of interbank reserves, if you would, and they would settle transactions among one another with their own kind of interbank reserves, I guess you could call them, to make it simple. So it's similar to how it works with the Fed, except it was just completely bank to bank, and it would be settled among the banking system. So not that much has changed. Instead of settling transactions oftentimes with the Fed now, banks just would settle them amongst themselves, almost with kind of like reserves, but they were just amongst the banks, if that makes any sense.
Okay, yeah, that does make sense, because I'm trying to think through, because as you said, bank reserves, there weren't so many bank reserves. There were like 40 billion bank reserves. Right now there's like 4 trillion post-QE. So if you think about how banks were settling transactions, because obviously if they weren't using bank reserves, or as you said, they were using some kind of reserves, but it was something that banks actually agreed upon, because Jeff Snyder points out that prior to quantitative easing, the asset side, you said it depends on what the liability is. But if it's cash, the asset side would be called a cash or cash equivalents, if I'm not mistaken.
Mm-hmm.
So the way I think about it is, even though we have a lot of bank reserves right now with quantitative easing, because everyone is saying it's money printing, are banks really using these new bank reserves to, say, for example, buy treasuries at auction, to buy whatever the hell they want to buy, or to settle transactions? Or are they still using the same things that they were using before quantitative easing?
So they're doing both, right? Just like you said, that the assets are the cash and cash equivalents can be oftentimes treasury bills, right? On the short end, collateral. Nowadays, reserves are considered cash equivalents from an accounting and regulatory perspective. So it depends. It depends on the bank, depends on the transaction. Do they have excess reserves? Then they might just settle in reserves. They want to get rid of them, right? If they don't have excess reserves, or which pretty much everybody does this day because there's an abundance of them, they're going to settle in, like you said, cash or cash equivalents. Now, reserves themselves, they can't leave the banking system. However, they can be used to almost buy treasuries. They can be used as like a deposit. So when a primary dealer buys treasuries, bonds at auction, they don't have to come up with the cash right away. Settlement date, when the cash is due, I think is like maybe a week later. So they can put up the reserves as almost like collateral, as like a deposit, right? So they'll put up the reserves as like a deposit, but they technically own the treasuries. So then they'll sell the treasuries to the public or to the commercial bank, who will then offer them to the public. So without actually paying for the reserves, they sell them. Then they get cash from the market, and then come settlement date, they use that cash to settle the transaction. So reserves don't actually buy them; they just kind of hold them. And allow the transfer of ownership to go from the treasury to the primary dealer. But come settlement time, they need cash, and they often get it from the market.
Yeah. That actually makes sense, and I hope a lot of the listeners are actually paying attention to that, because the key takeaway from what you're saying is they don't necessarily use reserves to actually buy those treasuries. They just using it as collateral, and then after they get the cash, because a primary dealer is not really there to just hold that bond. They're obviously gonna flip it or rehypothecate it or whatever they're gonna do, reuse,
Yeah.
replay it, what they're gonna do, and then they're gonna get the cash, and then they're gonna use the cash and give it to the treasury. Am I getting it right?
Yeah. Yep. That's pretty
Yeah,
much it.
yeah.
Mm.
So therefore, if they're using cash to give to the treasury, let's say the treasury needs to issue out 1 trillion in T-bills to pay for stimulus. Let's say they have a Build Back Better, whatever agenda that Biden has. So they have to raise one trillion, right? So they go into the auctions, and then they auction out, let's say they auction out 1 trillion in T-bills, right? And then the banks are not going to really buy it, or the primary dealers, let's use the word primary dealers, because there's bank and non-bank primary dealers. So the primary dealers are going to buy it with actual cash, but they don't have to buy it with actual cash at the moment. They can buy with they can actually put the cash in a future date, if I'm getting that correctly, in a future date. So
Correct.
when the government spends that money on stimulus, it's not using new money, which would be bank reserves. It's not using bank reserves, which it got from the primary dealers. It's using existing money. So money is just recirculating. Am I getting that correctly?
Yeah, absolutely. And that's exactly why, and I wrote about that fiscal spending is
Uh-huh.
just a redistribution of wealth, right? It's not, people think, you know,
Mm.
banks extending loans to consumers or buying government bonds and lending that way is the same thing, and it's not, for a couple of different reasons. One being fiscal spending is a redistribution; it's not an expansion of the money supply. Whereas
Mm-hmm.
a new loan to a customer is loaning new money into existence. That is an expansion of the money supply. So there's a big difference in that sense.
Ryan
Yeah.
Miller. Ryan Miller.
Yes.
Listeners, I'm Siyabonga Chuma. Couldn't introduce myself earlier as the conversation is heated between TUMISHO and Mr. Ryan Miller over here. So, Mr. Ryan Miller, I'm on the opposing side of what you just said between you and TUMISHO, and I also have other questions for you on the list. But I'd just like to touch on what you just said now on that the government, all it did with quantitative easing was just redistribution of money within the economy. So that is your
The
whole
fiscal
philosophy.
portion of it, yeah. The fiscal portion of it, yeah.
Yeah.
Okay, please elaborate for me on the fiscal portion of it before I
Well,
continue with my point.
Well, yeah, the fiscal spending, right? Government issues debt. They use that money to to fund their liabilities, social security, unemployment, to hand out stimulus checks, whatever it may be. New money is not created for that fiscal spending, right? Because when governments, like we were just talking about, auction off debt, they get that money, that cash from the market, whether it be you and me, a hedge fund, a pension fund, a foreign central bank, a foreign corporation, whatever it may be. Whoever's purchasing the treasuries are doing so with cash. So capital is just coming from one part of the market, and then the government goes to the government via debt, and the U.S. government is distributing it to another part of the economy. So it's just a redistribution of the money supply already in existence.
Okay, so since you're saying that it's a redistribution of the money supply that is within the economy, um, my question is earlier on when the show started, you said that after the whole COVID pandemic, you had a totally different outlook on the economy. So, as I'm saying, the government did that on buying treasuries and propping up securities and all
Yeah.
that
It.
during the pandemic, right? So, my question to you, Ryan Miller, is how come the government want now to increase the corporate tax in the United States?
Why do they want to increase corporate taxes?
Yes.
Well, taxation is one way they, fund their liabilities, right? I'm not, the whole from a political perspective is not usually how I kind of analyze things, but
Yeah.
I would think, especially recently with the widening of the wealth gap and the inequality that's happening. There's a lot of people that are living, their standard of living is falling. There's been a lot of social unrest over the years, and they see these big corporations, the rich kind of getting richer, to create a lot of social unrest. And you see, I guess this is more on like the Democratic side, that are more willing to tax these corporations because of them, have them pay their fair share, so to speak, right? That I think that's what's kind of been going around. But I'm not.
Okay, I wanna like narrow. Okay, I wanna narrow this conversation down just to ask you, what is your view on the monetary system, like the just monetary system of how we exchange goods and services based on money and the value we put on it?
The value I put on the system itself
Of fiat currency, yeah, like the whole
Oh,
system of money.
well, that's a tough question. I mean, the system works. I'll say this, right? Obviously, we used to be on a gold standard. Now we're just strictly fiat, and if you look back in history, all fiat currencies eventually go to zero, right? So we're eventually headed that direction, whether it's 10 years from now or 200 years from now, right? The U.S. dollar, I'm sure will, the U.S. fiat currency will eventually go to zero. But I think the system itself works a lot better when the government is less involved. When you let kind of the free market do its thing, the private sector is a lot more productive, and the private sector is what drives economic growth. So from the way the system sits, the way it's structured, the less the government does, the better. Unfortunately, we're in a time where politicians, they want to keep getting reelected, and in order to get reelected right now, they need to spend. Austerity is died, and spending and increasing the overall size of the government has become like the way forward, and unfortunately that just weighs on economic growth. Now, would that change if we went back to like a gold type of standard? It could, although I don't know. I don't think it would work. There's problems with that as well. The gold.
It wouldn't work, so to say. I don't mean to get historical, and
Yeah.
No, I don't believe it would work
I had
either.
this debate with Tumisho. Yeah, because I feel like with gold, there are lots of things involved. Remember the time when I think, what was it, Iraq, when they wanted to trade gold for oil, like quoted the same. So
Yeah, but also I also think like going back to Ryan's point, when you look at gold, like one of the reasons why I think gold isn't gonna work is because the free market, to say the least, the free market had already replaced it before Nixon took us off the gold standard.
That's
And this
correct.
is something that Snyder talks about all the time, because we are always told that the gold standard ended in 1971. Well, that's not true. That's not true. You have to understand euro dollars, which is one of the reasons why I wanted Ryan on the show to explain to us what euro dollars are. Because think about it like this: Bretton Woods happens. What was it? 1944. Everyone decides that, hey, gold is the US dollar is going to be the reserve currency. Basically saying gold is the reserve currency. And then you start seeing problems with gold because there's not enough gold to supply with the world to catch up with global demand. So the private system, to say the least, the private system found another way to get around the gold standard, and that was euro dollar. Am I right or wrong, Ryan? Can you
Yeah, and it was also not enough gold, and also the expansion of credit just wasn't happening at the level it needed to for the system. The way the system, the global economy was growing, you had that big boom post World War II, and credit just wasn't being expanded at the rate that it needed to, and that's when euro dollars kind of came in and fill the gap, right?
Yeah.
Because part of
Yeah.
the problem is gold. It's not even so much there's not enough of it. It's how it's used. It's often not distributed proportionately well. You go back to like pre-Great Depression. Part of the reason we got into the Great Depression is countries like France, like hoarding gold, right? If you're hoarding gold, you're not allowing it to leave to flow. There's not going to be credit expansion. It's going to lead to disinflation and deflation. So when politics get involved, politics and central bankers, things like that, it becomes a lot more difficult. But yeah, you're absolutely right. Euro dollars filled the hole that gold couldn't post World War II, and that started taking place in like the mid probably 1950s. Started really expanding into the 60s, and that's when the inflation started picking up. And then that was, like you said, August 15th, 1971, which is the date Nixon took us off officially. I guess you could say took us off the gold standard, the U.S. at least.
Yeah. And that kind of makes sense, because when you think about it, imagine there's a dollar shortage in the 1950s, and then suddenly this shadow money comes out of nowhere. But I wouldn't really say it came out of nowhere, because I think Snyder pointed out that the seeds were already sown for euro dollars back in the Federal Reserve Act, if I'm not mistaken.
Pre-Great Depression, we're right upon central bank Fed's inception.
Yeah, since the Fed's inception, I mean, it was already inevitable. It just took a serious boost in the 1950s, and that also goes to my next point.
Can I say this before you proceed? Okay, looking at the tactic that Nixon just put into place, as you said, the Great Depression happened because of countries like France hoarding their gold.
Well, that's part of it,
yeah. And obviously, when Nixon removed the dollar from the gold standard, it caused his reason behind that, as he said on his statement, is that he wanted to avoid the cost of transporting gold from one nation to another. So you just transport, you send it through another bank in the form of an IOU.
I mean, that's kind of nonsense explanation on Nixon's part, because that wasn't even really happening anyway. Because a lot of the times, all these different countries had accounts at, say, the Federal Reserve Bank in New York, and gold would literally get shifted from one side of the basement to the other, right? Oh, it goes from France to this country to that country, and it wasn't really going anywhere.
Yeah. And that kind of makes sense, because when you think about it, right? With regards to what Nixon says, and I would also like to point out what a lot of people on the FOMC, I don't know if it was called the FOMC at the time, maybe it was, maybe it wasn't, I don't know, but many of those meetings around that time, 1969, 1970, 1971, they didn't even mention, they hardly ever mentioned gold. They hardly ever mentioned gold and why its transportation issues somehow bad or something like that. In fact, in one of Snyder's articles, he pointed out the fact that in 1971, I think August, I'm not sure, when did Nixon make that speech when he took us off the gold?
August 15th, 71.
Oh, August 15th. I think it was in July. In July, in one of those FOMC meetings, according to the transcripts, he mentioned, or not he, rather the FOMC started talking about euro dollars, because they started getting aware of what's going on in the shadows. And I really want your take on how is it that central banks are no longer central? Because I've always said this, that central banks these days aren't central, because being a central bank means you do money, because that's the whole point of being a central bank. You do money. So if you can't even measure money, if you don't even know what money is, how can you be a central bank?
As a trader, we all know that feeling when it's NFP and you're about to go gangbusters on your trades, but then your broker widens their spreads like haywire. Well, most brokers, not Libertex. Libertex has zero spreads on almost anything from currencies, commodities, and even cryptocurrencies. So if you're really serious about joining a broker that has competitive spreads, you should try Libertex. The link is on the description below to sign up and enjoy the perks that come with trading with a world-class broker.
Could you just give me your thoughts on money, central banks, and the money supply? Because I think you had an article which was a good article. I think I'll put the link in the description. I think everyone should listen to that read that article. It's about why the M's are obsolete, the money supply. And I was talking to Sia about it when you said that you want to be interviewed on the show. I was talking to Sia about it, and Sia was like, "Nah, that's nonsense." Because I told him, I told him that, hey, dude, the money supply, whatever you see in the money supply, this isn't the real money supply, because this is a fraction of what the actual money supply is. And you just pointed it out so well. You just explained it so well in your article. Why M2, M1, M3, whatever those M's are, they all obsolete because they don't even capture the true money supply. Because there's a lot of money being created in the shadows, either through the euro-dollar market, repo. Yeah. I haven't even mentioned the repo market. So could you just
question?
Yeah.
How is money created through the shadows?
All right. So let me answer the first question first, and then we'll get to that. So the money supply, yeah. So the Fed, so the money supply, the M1, the M2, and whatnot, they capture, first off, they capture domestic dollars. They only capture dollars that are in the United States, and they only capture them that are in specific accounts, like savings accounts, checking accounts, money market accounts, and things of that nature. So any account that is not included in the M's, if dollars sitting there, they're not part of the money supply according to the M, the money supply metrics. Now the system accounts for them. Right? The global system accounts for them, but the money supply metrics do not. And the offshore dollar system, this euro dollar system, is bigger than the domestic dollar system. There's more dollars outside of the US, these euro dollars, than there are inside of the US. And that's when the Fed kind of lost control of the money supply, because in the 50s, the euro dollar system started to grow, and they failed to ever really take it seriously. They knew it was happening, but they never took it seriously. So they never knew the scale at which it was expanding. So they lost control of their money supply. They attempted to capture what was going on a little bit with like an M3, which they discontinued in 2006. It was a half-assed attempt to capture the actual money supply. But there's all these dollars that are happening. So we have a bank-centered system, right? And you could say we have a dollar-based system. Jeff Snyder likes to be more specific, say we have a euro-dollar-based system, right? And these offshore dollars, these global banks create these offshore dollars, and the Fed, nor the U.S. government, nor any other regulatory body has any authority in this market. So it is completely bank-centered. They make the rules. And the way they create money is by swapping assets and liabilities with each other, right? It's all about balance sheet capacity, risk to reward, right? If they have the ability to take on risk to extend liabilities to another bank, then they create these digital dollars out of thin air, right? So that market is not tracked at all. There are some regulatory or some bodies like the BIS, the Bank of International Settlements, that does like studies on them, and they'll try to capture what's happening in this shadow market, right? With this shadow money. But the problem is a lot of it happens off balance sheet, and we can get into why in a second. But there are tens and tens of trillions of dollars, probably hundreds of trillions of dollars, that are just floating around in some type of a vehicle in the shadows that are not captured by the money supply. So when people see the M2 rising, it's like, oh my God, we're gonna get hyperinflation, all that. No, all that really means is money went from non-M accounts into M accounts, right? So let's say a foreign corporation they have excess dollars, they use those dollars to buy US Treasury at auction, and then the government takes that cash and sends you a stimulus check, and you deposit it in your checking account. Well, now the M2 rises because those dollars, which were outside of the M's, not accounted for, now found their way inside the M. So the money supply metrics went up. Meanwhile, those dollars were already in the system. They were already accounted for.
There was no money printing. There was no money printing at all.
Correct.
Okay, that's deep. That's
that
very deep.
That is interesting.
I've gotten another perspective to this whole thing.
Yeah, and if you want me to continue with the off-balance sheet stuff,
please.
So we don't even know how many dollars are actually off balance sheet, because a lot of them are tied up in derivatives, and derivatives don't get put on balance sheet often because they have a net basis of 0. So let's take like FX swaps, for example, right?
Yeah.
Foreign exchange swap. So an FX swap is basically, it's a collateralized loan where two countries exchange currency. So let's say, or I'm sorry, not two countries, two entities exchange currencies. It could be countries, right? It could be central bank or whoever, but oftentimes it's banks and non-banks interacting with each other. So let's say a Japanese corporation needs dollars, right? And a European bank has dollars to give them. So the Japanese corporation may give the European bank Japanese yen. Say they need $1 billion. They'll give them whatever the equivalent of $1 billion is in yen. That's what they will give the European bank, and then the European bank will give the Japanese corporation $1 billion. So the net is 0. You have $1 billion and then a billion yen equivalent to $1 billion. So the net is 0. So they don't put it on the balance sheet. However, that's the first leg of the FX swap. Now, the second leg of the FX swap, because they have to swap those currencies back at a later date. Okay, that's what's called the FX forward. So the second leg of the FX swap is called the forward rate, or the forward exchange, the forward swap, where they exchange those two currencies back, right? Yen for dollars, except the Japanese corporation who's borrowing dollars is going to pay it back with some interest. Okay, now one side can occur a loss, one side can occur a gain if the exchange rate fluctuates a lot. So if the exchange rate fluctuates a lot, that might show up, or that will show up on the balance sheet, right? That portion of it. But the initial portion where it's the principal and interest that has to get paid back, or the principal that has to get paid back, doesn't show up on the balance sheet, even though there was $1 billion that just got loaned into existence, right? So there's literally tens of trillions that can, and you take in consideration FX swaps, currency swaps, FX forwards, interest rate swaps, all these different derivative markets. We're talking in the hundreds of trillions of dollars, and a lot of this stuff just doesn't ever appear on the balance sheet. Or if it does, it's like Jeff Snyder always says, it's like deep into like in the footnotes, right? You have to kind of dig through it and find and kind of put pieces together to kind of figure out, even have an idea of what's happening off balance sheet. And even then it only captures a portion of it.
So we could say there's another realm of economics taking place on the underground, because obviously there is a reason why these things aren't put into sheet, or you have to put the puzzle together.
Speaking
exactly.
Speaking about that, see, one thing I wanted to interrupt Ryan when he was talking about the euro-dollar market being larger than the actual M2 or whatever the Fed can actually measure, is I heard apparently that the euro-dollar market is 4 times the size of whatever M2 or M3 or M1 or whatever M's can measure. So that actually makes a lot of sense. If there's so much money in the shadows that the Fed can't even measure, and if that shadow money is contracting, there is no way we can have sustained inflation, because inflation is always a monetary phenomenon. I mean, that's Milton Friedman right there. Inflation is always a monetary phenomenon. And if inflation is a monetary phenomenon, in order to get sustained inflation, you need that monetary aspect. You need an expansion of money. You need an expansion of money. And if you're not going to get an expansion of money from in the shadows, then you're definitely not going to get inflation. I mean, am I right or wrong?
Yeah. I mean, here's the thing. Even if you have an expansion, like expansion of money is positive, that doesn't necessarily mean it's enough for the system to grow or enough to, get sustained inflation. It's about the rate of change too. From like post World War II up until 2008, we were on this growth path of credit expansion. The euro dollar system was on this certain growth path, and we have, since 2008, it has dropped off considerably. So even though banks are still lending, they're not lending anywhere near the rate they were pre-GFC, and so we've never gotten back to that level. And because of that, real economic growth has struggled, right? 2009, despite all this money printing, these bank reserves, there's trillions of them, from 2009 through the first quarter of 2020 was the weakest growth period in history. And we've also experienced disinflation throughout that same period, right? Yeah. It's because the banks are not lending at the same rate that they were lending prior to the global financial crisis of 2008. That's the problem.
And that's also another reason why, if you look at the boom in euro dollars, I think it's safe to say the boom in euro dollars in the early 2000s. I think that's one of the reasons why the dollar was so weak at that time. The dollar was so weak. I think the dollar, I think it bottomed at 70 on the Dixie, if I'm not mistaken, right? I think it bottomed in 2008. Yes, in 2008, it bottomed at 70 something. I'm not sure. But can you say that the dollar's weakness was a direct impact of the euro dollar system booming around that time? And then I think it was August 2007, I mean, you start seeing the system breaking down, and then that was the reason for the global financial crisis. It was a breakdown of the euro dollar system.
Yep.
Yeah.
I'm sorry, what was that question that you asked?
No, it wasn't a question. It was just a comment.
Oh, yeah.
I have a question though, Mr. Miller.
Oh.
What is your take on Bitcoin and its role in this day and time and age?
Well, so the breakdown of the global financial the breakdown of the Eurodollar system in 2007, 2008 has paved way, I guess you could say, for alternative monies, alternative systems to try and pop up, because the dollar system doesn't work the way it used to, and because of that, the global system doesn't function like it used to. That's why we have weak growth and disinflation and sometimes outright deflation in certain areas like Europe and Japan. So Bitcoin has risen because of that. Now, currently, as it sits, there is no alternative to the dollar system. So in that sense, Bitcoin has no role, right? Because it is not an alternative right now. It is not a medium of exchange. It's not a store of value. It has no role in that sense. Now, it doesn't mean it can't in the future, right? As as the system continues to break down. But right now, as the system is structured, Bitcoin is not an alternative to it. Not yet.
Yeah. But I mean, Snyder would point out, because I read his article on Bitcoin El Salvador. He had some link, and I think I've mentioned this on this podcast in one of my old episodes, because I mentioned that El Salvador turned to Bitcoin because it had a problem with a shortage of dollars.
Yep.
So I think, in a sense, Bitcoin is there to solve a dollar shortage in El Salvador, and possibly around Central America and South America, and maybe even countries in the future that may be struggling with this dollar. So
well, they're definitely hoping Bitcoin will solve their dollar problem. I'm not so sure that it will. We'll see.
Yeah, we'll see. Only time will tell.
Yeah.
Yeah.
Yeah, but
anything you want to add on, Sia? Anything you want to add on? Because I think I have one more. Sorry, I have two more questions. So, just before I ask those questions, Sia, do you wanna say something to Ryan?
No, I hear you, Ryan, saying like that's the whole notion that's going around where everybody will come and look at Bitcoin and be like, oh, Bitcoin is not a medium of exchange, it's not a store of value. Of course, it does have the potential
yeah,
of being a medium of exchange in the future. And this is just my personal view. I feel like Bitcoin is being held back now because of the government, the certain structures they have in place, and the laws that they're trying to implement. Like, for instance, if you look at China, the 2 or 3 months back when they shut down Bitcoin mines in China, that was a direct sabotage because the government fears that if it no longer has the control, you see, with the government, when it comes to fiat currency, they can increase the circulation and expansion. They have control to those things using their
To a certain
monetary policies. But now, to a certain degree, now obviously when it comes to Bitcoin, I think it's capped to a certain price. We can only mine so much Bitcoins. So, but that's not the point here. The point is I see a future in Bitcoin because I feel like Bitcoin, if ever, to me, sure, you always say this, you are even you, right, Miller, you just said the problem is that the government is intervening in the economy. So if ever Bitcoin were to be a medium of exchange, I think it would be a great base for a free market, don't you think? Because nobody gets to 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 have certain rules on how to exchange your money or takes you so much as
yeah.
compared to the government.
I love the idea of Bitcoin, right? This revolution, right? Government's always intervening, the corruption, all this. I do like the idea of Bitcoin. But just like a gold standard, I don't think a Bitcoin standard would work either. I think there's going to be some variation of Bitcoin in the future that may, that they develop that's going to be even better than Bitcoin is. That may be the
True.
the new digital currency, whatever it is. I don't personally think it's going to be Bitcoin. I think Bitcoin right now is it's
Mm-hmm.
at like $60,000, and it's an open ledger accounting system, right? Which is nothing new. It's been around like 1,000 years.
Okay.
Open ledger. The only thing that's new about it is
Mm.
it's now digital, right? So that technology is not worth, in my
Mm.
opinion, $60,000. It's being bought. I mean, it's up like 1,500% since March 2020 on the idea that the Fed's actually printing money. They're not. The dollar is going to die. It's not anywhere near that. And we're going to get hyperinflation, which we're not anywhere near that either. So because of that, it's completely overvalued, in my opinion. Doesn't mean it can't continue going higher. I mean, look at the stock market, right? Look at that. Like, doesn't mean it can't continue going higher. I like the idea of Bitcoin and what it's trying to do. I think it's like the first step. I don't think it's going to be Bitcoin. I think it's going to be some other technology and maybe some variation of it down the road. That's what I think.
Here's what I have to say. I feel like the cherry on top for Bitcoin would be printing out notes and coins. Imagine having a Bitcoin note. Okay, I mean it's a coin, but to put the value on a note. You catch my drift, guys.
Yeah, but 97% of transactions are digital now, so you'd be going backwards in time.
Yeah.
No, not essentially. Not essentially. What I'd be doing is I'd be tapping people into the system of Bitcoin. Because psychologically, when you talk about money, people want to have access to it. Yes, now we are transiting into the digital age, but still cash is king.
It's king if you're in the cash business. The euro dollar based system that we're on is completely, forget digital. It's completely virtual. But
Yeah.
I see what you're saying.
Yeah, it's the bookkeeper's pen. But yeah, Bitcoin my take on Bitcoin is I'm a big Bitcoin critique, but I'm not against it entirely because as Ryan said, Bitcoin is a good idea. I mean, it's a good idea. It's just that in practice it doesn't work like that. First of all, for money to be money, for money to actually be defined as money, the way I define money is it has to be a medium of exchange, unit of account, and a store of value. Bitcoin doesn't fill any of those roles, but I think it fills one of them, which is a unit of account, because essentially
that's the easy one.
Yeah, that's the easy one because it's ledger money. It's ledger money. As Milton Friedman says, it's the bookkeeper's pen. So I think it only fills one of those roles, which is the easy one. But I don't think if it can be a medium of exchange, which I highly doubt it, because imagine a medium of exchange which just the value of that specific currency drops by 20% in a day. I mean, that's not a stable medium of exchange when you think about it. Imagine Tesla pricing their cars in Bitcoin. I remember Elon Musk did some gimmick like that in March, if I'm not mistaken. Was it March? Yes, it was March, when Elon Musk said he's going to price his Teslas in Bitcoin. But that wasn't really, that's not how it really went down. Because think about it. Elon Musk, when he announced that, when you actually buy a car in Bitcoin, when you buy a Tesla in Bitcoin, right, there is some window before the price actually changes. There is I think there's a 30-minute window where you can actually, you have to buy that car, you have to purchase that thing in a 30-minute window or something like that, because he understands that the price changes every single second, even on weekends. So when you think about it like that, I don't think it's a stable medium of exchange, and I don't think it will ever be a stable medium of exchange. And neither do I think it's a store of value, because there's nothing to store. It's all digital. You're not storing anything. You can't poop on your Bitcoin. You can smell your Bitcoin. You can't do anything with your Bitcoin. So that's my take on Bitcoin. But just taking a different turn, I just wanted to ask you about MMT. Okay, but before I get on the point of MMT, before we close with MMT, I wanted to ask you, Ryan, about, let me just check my questions. Yeah, I wanted to ask you about the whole thing about swap lines, right? You know, the Fed has swap lines with other countries. So just to explain what swap lines are, I'm not an expert on swap lines. I haven't done much research on it. But from what I know, it's like, let's say we all know that the dollar is the reserve currency, or euro dollar to be more specific. But let's just say the dollar is the world reserve currency, right? And then let's say a corporation in Japan like Mitsubishi, right? Mitsubishi is a Japanese company. Let's say Mitsubishi needs dollars because it needs dollars to buy. I mean, many things are priced in dollars. I mean, let's say it needs to buy oil, example, right, from Saudi Arabia, and Saudi Arabia only wants dollars. So Mitsubishi goes to Bank of Japan and says, hey, we need dollars. And then Bank of Japan says, okay, let's do a swap line with the Fed. So the Fed transfers them. I don't know what they're transferring. That's why I'm asking the question. Is the Fed transferring, let's say they need 100 billion worth of dollars, $100 billion for that swap line. So the Fed transfers $100 billion. Do they transfer $100 billion in bank reserves, or is it actual money?
So this is what happens. So it doesn't actually get really transferred anywhere, because it's just reserves, right? Reserves can't leave the banking system. So unless you have an account with the Fed, you actually can't get access to reserves. Like me and you can't get access to reserves. So like Mitsubishi is not going to have access to the Fed. They're not going to have access to reserves, but they may have a bank account, and they may have an account with a bank, and that bank may have an account with the Fed.
A subsidiary.
Right? Yeah.
Yeah.
So they'll increase the reserves of the account that is held at the Fed, and then so part of the whole thing with quantitative easing is like, oh, if you give the banks reserves, they can lend. Well, they don't lend the reserves. It's just, like I said, the reserves from an accounting regulatory perspective are like cash or cash equivalents. So it it kind of backstops the loan, right? In a sense, but they still have to risk their own capital, the banks, and that's why it doesn't matter how many reserves you pump into the system, banks still have to risk their own capital in order to lend, and with conditions the way they are, that's why they're not lending. But to get back to your example, they increase the reserves with the bank account that is held at the Fed, and then that bank can then go and create a new loan off of those reserves, new dollars off of those reserves. So all that's really happening, especially with swap lines, right? When other countries need swap lines, say it's the ECB, right? It's a collateralized loan, right? So the ECB is going to have an account with the Fed, and the ECB is going to give the Fed euros, and the Fed's going to increase their reserve account by X amount of reserves. And then, so now technically the way this whole credit creation things work, you don't actually have to have dollars. It's very weird. You don't need dollars. All you have to do is have quote unquote access to dollars. Okay. If you have access to dollars as a bank, you can then go and create new dollars. Okay, so the ECB now has access to these dollars, and what they do is they then basically loan out these dollars to banks, to European banks, who then create additional loans to European corporations. So by the time the corporation actually, in this, let's say Mitsubishi, if we did it with Japan, let's say it's a European corporation. By the time the European corporation gets those dollars, there's already been like a couple of loans. So what they're doing, these loans, these swap lines have to be paid back. So in order to pay them back, you need dollars. So it just further indebts the world in dollars. It further reinforces the euro dollar system. Is what it does.
Yeah.
You two are a very big fan of the euro dollar system, eh?
At the end of the day, it determines the direction of the dollar.
Yeah.
That's
it. It's basically
long term.
Yeah, long term. It's basically how the system works. If you don't understand it, I mean, I'm trying to learn it. I'm still learning it. But if you ignore it, because I haven't heard any inflationists talking about it at all. I haven't heard people like Peter Schiff say, "Oh, euro dollars are contracting." No, all I hear is money printing. Yeah,
because it fits their narrative.
Yeah. They are wrong, because when I started learning macro, I learned macro through him, Peter Schiff, and George Gammon. So I learned macro from the lens of inflation this, inflation that, which was actually a good thing, because I learned it from a free market perspective. I didn't learn it from a mainstream perspective. Because if I learned it from a mainstream perspective, I mean, it'll take a long time.
Schiff's an Austrian, right?
Otherwise. Yeah.
So that free market perspective is good. It really explains like how the system supposed to work. The only problem is we don't have a totally free market because we have too much government intervention.
Yeah. And speaking about government, which just leads me to my last point. With MMT, right? And I've been meaning to talk about MMT for a long time, and I will do a separate episode talking about MMT and basically debunking it. Modern monetary theory. One of the biggest MMT prophets, to say the least. Yes, prophets. Stephanie Kelton, Warren Mosler, and I don't mean to call them out or anything. I'm just trying to make a point, right? So MMT, right? They basically say that the government has a monopoly on the currency. That's their first point, which is wrong, because as Ryan has said, there is a lot of dollars that are being created in the shadows, which the government has no idea of. So by that definition, they don't have a monopoly on their currency. Secondly, their point is they make this point about the fact that government doesn't need taxes. They don't need to go into the bond market and auction out treasuries or borrow money, or they don't need to raise taxes or issue taxes in order to pay for stimulus or whatever program they want to do. Government doesn't need taxes to fund their spending. Their spending funds taxes. So that kind of sounds confusing, because what they're saying is what they're basically saying is, so let's think about it from a balance sheet perspective, right? You have the TGA, right? The Treasury General Account. In some other countries, I don't know what account they call it. In South Africa, it's the exchequer account. I think it's the same as England for many reasons. So the TGA, the government's account with the Fed or with any central bank, quote unquote central bank, because they're not really central. The TGA, right? This is the accounts. This is the checking account of the government, where the government uses that money to spend and do whatever nonsense they're going to do with that money. So they say that when the government spends money in the TGA, they create an overdraft. Basically, they're saying their account goes negative. So by definition, they're spending money into existence. They're basically creating money out of thin air when they spend money. And then when they tax people, all the taxes is doing is it's paying for that overdraft. So taxes is taking money out of the system. And when they spend, they I know it kind of gets funny and stupid when you think about it. But what's your take on it? Do you think the government actually spends money into existence and they run an overdraft? Is that what you think, Ryan, or do you have a different opinion?
On that specifically, I haven't really thought too much about it because I don't know. I haven't really thought about I've heard it before. I haven't really thought about that too specifically. But I don't even think it matters for what MMT is trying to do. If we were to get MMT, the whole system would change dramatically. And you should call out these Stephanie Keltons and Mosler and whoever else, because I think their ideas are very dangerous. This whole MMT, because so people think we have MMT right now. Modern monetary theory is nothing new. It basically just explains how the system is. But if we were to get kind of full-blown MMT, what they're saying, the government wouldn't have to auction off, or the Treasury wouldn't have to auction off debt anymore. The government would just be able to spend money into existence, and they're claiming that's already happening. I don't know. Let's not argue the nuances of that or the mechanics of that. But if you start spending money into existence, they just think, oh, and then when the time comes, if inflation starts to get out of control, or we think it's going to get out of control, oh, we'll just raise taxes, right? It's that simple, right? Now that doesn't take into the account politicians, right? You're telling me if a politician, let's say it's election year, right? We're in the same type of environment we are right now, where spending is what gets you reelected. Spending cuts get you kicked out of office. So or taxes get you kicked out of office. So let's say we're in election year, inflation is starting to get out of control. Maybe it doesn't matter which side is, has the authority. Inflation is starting to get out of control. We're going to expect, and we think we can rely on the politicians to do the right thing and raise taxes to the appropriate level to curb inflation. I think that's very naive. Very naive. What's that?
That's unrealistic.
Yeah, absolutely. And as we've seen, or actually, I don't know if we got into it too much. The more the government spends, the more it weighs on economic growth, because when the government spends money, it pulls capital and labor and resources from the private sector. And the private sector investment, private sector consumption is what drives the economy, what drives growth, right? So the more the government spends, the more it weighs on economic growth. And you can easily see this. You can pull up a chart from 1980, 1990, as we've started to become over indebted, as we reach that kind of threshold of 90% debt to GDP, which a lot of studies show it kind of triggers this law of diminishing returns, where this is what Lacey Hunt talks about. Every dollar of additional debt, once you hit about 90% GDP, every dollar of additional debt produces less and less in the real economy, right? So we're beyond that threshold. We're already at 130% GDP. But if you look at government spending from like 1980, 1990, or you can look at debt to GDP, that's been rising. Real economic growth has been falling, right? They've been pretty much inverse of each other. So now we have this situation where government could just spend freely, just spend into the economy, just spend freely. That's going to really thwart the private sector. I'm not sure where we're going to get economic growth from, because government spending has proven to be largely unproductive, right? If you go back to post-World War II, if you look at the marginal revenue marginal revenue product of debt. Again, this is more Dr. Lacey Hunt. $1 of debt produced something like 75 cents of GDP. Fast forward to today, and we're at about $1 of debt produces like 35 cents of GDP. It's very unproductive because a lot of our debt finance spending goes towards, social programs, entitlements, unemployment, Social Security, things of that nature. These programs don't contribute anything to the economy. So that's why the government is largely unproductive in their spending, right? And the government has gotten bigger and bigger. Government spending as a percentage of GDP was like 5% post World War II. Pre-COVID, it was 17%. Post-stimulus checks, it was about 35%, but since it's dropped down to about 25%. So since post-World War II till now, you could say the government is increased from 5 to 25%, or about 20%. They've grown. The government has, become a bigger factor of the economy, and you can look at what it's done to economic growth. Economic growth just gets weaker and weaker and weaker. And that's why we see bond yields on the long end of the curve. They keep falling because they price in inflation and growth expectations. Since 1980, as growth has gotten weaker, bond yields on the long end just keep falling and falling. So I don't see how, just spending money into existence is going to, one, they're not going to be able to tame inflation because we can't trust politicians to do that when it's necessary. And two, it's just going to weigh on economic growth. So if you're going to have higher levels of inflation, higher interest rates, there needs to be growth in order to absorb that. If there's no growth and we get into a situation where there's higher levels of inflation, well, it's not going to be good for anyone. So, and that's the path of hyperinflation. People want to talk about hyperinflation. Let's go full-blown MMT, and then that's the path you go on, and it's very dangerous. Just talk to Venezuela or Zimbabwe, right?
So. And that actually makes sense. And if you don't take Ryan's word, if you don't believe him, there's actually empirical evidence for this.
A lot of studies done on
it. There's this study that Lacey Hunt pointed out by these Swedish econometricians Berg and Henriksen, where they concluded that that government size, the size of government, is negatively correlated with economic growth. So, there's multiple evidences of proof that show that government spending results in lower economic growth. But, the MMT guys won't listen to me. And with regards to taxes, just before I close, if inflation gets out of control, MMT guys, we'll just raise taxes. And I'm not even talking about from the political will of raising taxes, but will actually raising tax rates help? Because if you look at a chart if you compare tax rates, the top marginal tax rate, right? The top marginal tax rate, and if you compare that with tax revenue as a percentage of GDP, it's remained constant at 17-18%, around that range. Despite, it doesn't matter how high the tax rate is or how low the tax rate is, the government still collects the same amount of money. So you think raising the tax rate is going to help? Historically, that's not true. So I don't see MMT working just because of those reasons. But thank you, man. Thank you, Ryan. Thank you for your words of wisdom. I think I'm gonna conclude this talk. This was a very, very, very empowering talk, to say the least. It was. I think you also enjoyed it, Sia. You have to admit you also enjoyed this.
Yo, I'm blown away. I'm out of words. I wish the conversation could continue more, but Mr. Ryan Miller, you really sparked my mind. That was food for thought. Thank you so much.
No problem. I enjoyed it. We'll have to do it again sometime.
Yeah, definitely.
I told you, this guy is a beast, man. I told you.
You're a beast, fam.
Yeah. I'm just trying to learn like you guys, right? You get some things wrong, you get some things right, and you're just trying to learn. That's it. That's all.
Yeah, it's all about and critical thinking.
I'm going to do some research after here. I need to tap into more research after the things Ryan Miller said and mentioned.
Read his articles. Yeah. Read his articles.
Will do so. I'll be a subscriber from now on.
I appreciate
Yeah,
that.
you'll copy the link to me, Shone. You'll send me the
Yeah,
link.
yeah, no problem, no problem. And Ryan, where could our listeners find you on social media, email, anything? Where can they reach you?
Yeah, I mean, I'm on Twitter a good amount. Ryan Miller _TE. The TE is for trading economics. So Ryan Miller _TE. You can go to my website, rmiller. tradingeconomics.com. Miller is MILLER, so rmillertradingeconomics.com. My articles also get posted to fxstreet.com if anybody uses that website as well. But yeah, those two websites, mine, fxstreet.com, and then Twitter.
Yeah, thank you. It's a pleasure. It's a pleasure to have you on. And by the way, you know how I actually found you, Ryan? I found you. I was Googling repo. I said repo balances. I just Googled repo balances, and then suddenly I see a bunch of articles. I see a Forbes article. I see all these stupid articles from CNBC. You know, I can't trust CNBC. And then I see an article on FX Street. I mean, I like the title. It says why the M's are obsolete, and I'm like, this is the article I've been looking for. Okay, fine. I click the link. Okay, it says Ryan Miller, and I'm here connecting my PC to the TV. And as I'm scrolling through the article, I'm like, damn, like the first paragraph blew my mind. And then I realized that now, you know what, I have to sit down carefully and read this thing properly, so I can digest this thing. Like, guys, this guy is a special dude. He's extremely special, guys. You read his articles. If you don't read his articles, you're not serious about life. What are you waiting for?
I don't know about all that. I appreciate it though.
Please read his articles, and we hope to have you on the show in the future. So
Yeah,
thank
absolutely.
you, man. And we will see you guys on the next episode.